So once they're put into the qualified opportunity fund, assuming that the opportunity fund maintains its status for the duration of the investment, a couple things happen. Once the gains go into the fund, the basis of the gains gets set to zero. If you hold those gains in the fund for at least 5 years, or at least until 12/31/2026, your basis in those gains gets stepped up from zero, gets a 10% step up in basis at this point. So at 12/31/2026, an investor is going to have what's called an inclusion event if they haven't sold off their investment already in the fund. And that inclusion event is basically when the taxpayer has to pay taxes on those capital gains that they invested. But if they've held those gains in the fund for at least 5 years, they'll have to pay taxes on 90% of what they would have had to pay otherwise if they did not invest the funds into the qualified opportunity fund. So assuming that the investor keeps the gains in the qualified opportunity fund for another 5 years or so, if overall the investor has those gains in the opportunity fund for at least 10 years, then when that investor goes to dispose of or sell his interests in the opportunity fund, then on that disposition, they don't have to pay any taxes on capital gains. So you have a front end benefit for capital gains taxes where you get a step up in basis, and you get to defer the taxes, the payment of the taxes, until the latest 12/31/2026. And on the back end of the investment, you get to walk away from the opportunity fund tax-free in terms of capital gains.